Welcome to another episode of Mere Finance, your usual Sunday video. Today we're going to talk about the used car prices in decline. Is it a credit crunch or a demand crunch? Credit crunch by meaning consumers are not having enough money or banks are not lending money for them to buy, or is it because consumers just don't want to buy cars? So which is the driver? But before that, don't forget to subscribe as usual, so this can give us more exposure and more people can learn about the markets and the insights. So consumers usually don't care about the price of a good. Buying a car is one of the biggest items in the shopping list that a person will do during their financial lifetime. Other than a house, I would say the car could be the second biggest purchase. But the way it works is that consumers are payment shoppers. They're basically price insensitive because they really look mostly into the monthly payment. When someone is budgeting for the year and they want to buy a new car, they usually don't care about the price of the car. I've seen people with $60,000 salaries buying $60,000 cars. Because car salesmen are able to increase from 5 years to 7 years to 8 years the loan term, then the payment goes down, and then people are convinced that, I can afford the payment. They probably cannot afford the car, but they can afford the payment. So if the payment is $400, $500, and they make after taxes $3,000, then they're like, I can afford that. But in the long run, it doesn't make sense. But that dynamic creates a whole different way of perceiving how the used car market works. Because then, who is in charge? Is it the consumer? Is it the supplier? Or is it the lender? So the driver of used car prices usually is the auto lender. And in this case, we have seen reduced loan-to-value ratios. That means bank or lenders are lending less money because they need to hold more money for their balance sheets. There is larger down payments. So if you have a $60,000 car, usually around you put 20%, you have to put $12,000. Before, it might have been only 10%, so $6,000. So people or consumers, instead of putting $6,000, now they have to go for $12,000, which of course reduces the demand because not everyone will be able to pay that amount. And another one is bigger fees. By bigger fees, we mean interest rates, we mean financing costs, we mean credit reviews, and so forth. So let's start with the first one. But before that, look at the total vehicle sales percentage change. We saw a huge increase in 2020. After the pandemic, you can see increase almost to 40%, then start dropping. And since then, it has been relatively stable, like very cyclical. Now we have seen 3 consecutive periods of no greater change than quarter 2022. So it has been steady around 8%, 7%, 2% in the month-over-month total vehicle sales, which mostly includes used cars. So let's start with the first aspect, reduced loan-to-value ratios. So if you can see here, consumer loans, automobile loans, all commercial banks, look at the drop at the end of almost 2% month over month. And this is not new. Like a drop like that signifies something. It signifies that banks are holding into their cash and are lending less money. You can see overall it's really close to 0%, the percentage change. But recently it has just been dropping tremendously. So that means actually banks and lenders are caring about their loans and they're holding to that aspect of a higher loan to value ratio. Along with this, domestic auto inventories have constantly been going up, which is good because more demand. So if you have tighter lending and higher inventory, there's more demand, but there's less supply of credit, so the prices tend to go down. Then the second aspect, larger down payments. How do we analyze this? Fortunately, we don't have loan-to-value ratios from auto ABSs. That's information that I have to subscribe to a vendor, but we can analyze the average amount financed for used car loans at finance companies, and you can see it's dropping from 25,000 all the way in quarter 3 of 2022 to less than 24,000 in the first quarter of 2023. I think the Fed will release a new data point in the upcoming weeks for quarter 2. You can see a small drop, which means the average amount financed for the used cars is coming less. So actually, banks are lending less money, or consumers have to increase their down payment to meet the credit expectations. So this is very interesting to see. We'll see if it will keep going down, but I think it will. And the other one is the bigger fees. You can see the average finance rate of used car loans at finance companies, amount of finance weighted. So it will be really nice if we can divide this by credit rating, so like subprime, super prime, prime, junk, etc. So to make sure that we don't cluster everyone into the same bucket in terms of credit. But you can see that since 2021, the interest rate has gone up. Now it's almost around 16%, which also, this is an average, and most buyers usually have a good credit score. So that means that there's a premium. So probably people that have bad credit scores are paying 25 to 30% in the interest rate, so which is kind of concerning. And your higher interest rate also puts a perspective that your monthly payment also will go up. So the bottom line is consumer demand is good, inventories are going up, but the lending supply is going down. And how do you position yourself? Probably as an investor wouldn't touch much of the auto companies, and also I will be careful with some banks that have high loan to value ratios in the auto sector, because probably it's going to be a huge decrease in the credit crunch. So I hope you enjoyed this video. Please comment anything that you found interesting or any questions you have, and we'll see you next Sunday in another episode of Mere Finance. Thank you.